Oh, I know, futures. Energy. There we go. Now you can see. Well, same thing happened the other time too. Anyway, so we got a bounce. Oil was down and went back up, but we're still running into the problem at 66.50. That's still the shorting zone for oil. Although into the long weekend and the holiday, I would not short it. It's a little dangerous. You know, when you get a drawdown the week before holiday, well, this doesn't show it, of course. Oh, here you go. Just updated. Good. All right. So oil imports, blah, blah, blah. Commercial inventories decreased to 1.7. Yeah, it's obviously saying the same thing. Now, what happens the week before holiday is people, the gas stations top themselves off because they say, oh, maybe there's going to be a lot of people driving this weekend. So they'll order an extra truck and make sure all their tanks are filled. So you get a demand for gasoline before the holiday. That doesn't mean you're going to be busy. It doesn't mean it's going to get sold on the other side. What can happen in a holiday is that the gas stations top off their tanks anticipating a large amount of drivers showing up. Then if a large amount of drivers don't show up, what happens in next week is the gasolines don't reorder and you can have an actual build the week after a holiday. So you can end up being disappointed. What you do, if you want to really bet on this stuff, is it's not about this drawdown. That's normal before a holiday. That's just somebody planning to have inventory. But what happens is if you see the MasterCard has pulse spending, shows like how many people are on a holiday weekend, they'll generally figure out how much gasoline is used if it's more or less than a normal weekend. And that gives you a good insight as to how much driving is actually being done. And then you see if there's going to be a build or a drawdown. You also have to consider where were we last year. So this year, 19 million barrels were supplied. I'm sorry, this year 19 million barrels were supplied. Last year 16 million. So there's a lot more, like 20% more supply is on the market than there was last year. So if we don't see a 20% uptick in driving, this can get pretty ugly next week for the gasoline side, especially. But on the whole, it's a healthy thing for the a healthy demand look for the oil futures. But if we see a really big run up and it gets silly, then we might want to short it. But at the moment, and don't forget, 70 on Brent continues to be a very tough thing to cross. 70 is a hard line to cross. Now notice if we go to WTI, 66.50 has been the line. Now, this was 70 on Brent. This was 70 on Brent. We're not even at 70 on Brent now, and we're slowing down on WTI. So that's a sign of some weakening demand. We'll see what happens next week. But I think what's going to happen next week is that Wednesday's numbers next week are going to be through Saturday or Sunday. Well, what's this one? Ending May 21st, which was, well, that was a while ago. That was Friday. If they're only giving you a measurement until Friday, that's not telling you much. That's interesting. So I'm sorry. So next week should have a bit of a draw. So that means next week, and plus it's going to be Thursday next week before they report. They're either going to give us the Friday number or the this week number or Sunday number, something like that. But whatever they give us, it's going to be this week for the people filling up their tanks, going on their holidays and into the holiday weekend. So it's going to be, they still have a good chance to get a good number out next week and show a good draw. The week after that, though, is when you want to look for a disappointment. So that's what we're going to do. If we can see some crazy spikes up, we are probably going to want to short it after the holiday. But you don't have a long time to short it after the holiday because then everybody starts getting excited about July 4th. We go right from this holiday into that holiday where everybody gets thinks that you're going to need a ton of oil. I don't see it though. I don't really. I think yes, a lot more people are going to be obviously a lot more people, but we're already supplying 20% more than we supplied last year. So the question is, will it be 20% more driving than last year for people going out? Probably. It's hard to say if you can use that much more fuel. Actually, it's not that hard because let's do the math. I mean, let's say we have 100 million families in the country, and let's say that let's say half of them can't all take a trip, right? Someone's got to be home. Somebody's got to be at the barbecue. Let's say half of them, 50 million people, go 2 hours away on the average. So 50 million people, well, let's say 4 hours. Let's go crazy. So 50 million people, 4 hours. 4 hours is 200 miles in gas, 500 miles round trip. Let's say they get 25 miles a gallon, so that's 20 extra gallons. So now we have a number. So 50 million people consume 20 million gallons of gas that they wouldn't have consumed otherwise. And that's 1 billion barrels of gasoline. No, sorry, 50 million times 20 is 1 billion gallons of gasoline. Sorry, gallons divided by 42 is 23 million barrels. So if we have a robust, I mean, half the people go on 4-hour trips in their cars. This is obviously a big number, but the maximum number, so then it's 23, 24, something like that, million extra barrels of gas. Now, spread out over how long? Spread out over, they're either going to buy their gas on the way out or on the way back. So spread out over 2 to 3 week period of time, there'll be an extra 23 million barrels used, which is roughly 1 day of normal consumption. So here we have 11 million barrels being taken out in this week. So if we have another 11 million barrels taken out, that pretty much gets us to maximum consumption. Then you say, well, I don't see where more consumption is going to come from. Did you take an 8-hour trip from Memorial Day, or are you going to take an 8-hour trip in your car? No, you get 4 hours, 3 hours. After that, you might fly, you might whatever. And don't forget, airlines are certainly under capacity. There's no question about that. They're just getting back to capacity. So that's not going to give you any kind of special draw of gasoline or anything like that. It's really all about how many car trips people take. And so we're calculating here the maximum realistic effect of everybody jumping in a car and driving somewhere and taking a decent 4-hour trip there and back. And that would add 23 million, 24 million barrels of gasoline in consumption over a normal weekend when 50 million people don't take a 4-hour trip. So that's, you know, that's where these things get overplayed a lot, because people start going, oh, gas will be $70 and blah, blah, blah. It's like, why? And then what you have to do is look at petroleum status report. Is that what I'm thinking of? Data. Crude reserves, that's what I want to look at. Crude reserves. Crude oil production. Summary weekly supply estimates. Is that what we're talking about? Not really. Somewhere there's a weekly, I wish I remembered where these things were. Somewhere there's, oh, here you go, analysis and projection. Oh, stop it. Oh, it's a terrible website, Jesus. Come on. Are you done? All right. Forecast projections, consumption demand, inventories and stocks. Let's try that. Okay. Oh, I see. That changes this. So it's going to be petroleum, crude oil, 52 reports apparently. Oh, here you go. Status report. Yay, found it. No, that's not it. Son of a bitch. Stocks by pad districts, NYMEX futures, US and pad weekly. I don't know. Somewhere there's a summary which shows you some charts and graphs, and I can't find it. Petroleum. Recount pipeline. Diesel distillate. Oh, this week in petroleum. There we go. Aha! Okay. So this week in petroleum, 2019, 20, 20, and 21. Okay, so here we go. We're seriously higher in gasoline. That's $3. That's a big jump. So last year we were at $2.50. Now we're at $3 for price of gas. That's what I care about, the stocks. That's what I want to find out. So you're at 560. We're in the middle of the range. We're pretty much where we normally would be as far as amount of crude in our stockpiles. And let's call that 475. And so if we draw down 23 million, we're going to be at 440. So 440 is going to be here. So we're still basically in the middle of the range, although moving towards the lower part of the range. But you wouldn't extrapolate that because that's the holiday, and that's what happens at the holiday. That's exactly why these charts all dip. That's why the 5-year averages go down and go down, because June, this holiday, May, and then July 4th are two big draws on gasoline. But after that, you're back into regular summertime. Nothing exciting goes on, and in the fall we use less. So this is perfectly normal, and we're going to be in the middle of the range. So there's nothing. There's no indication of extra heavy demand. There's nothing special here. We have plenty of crude oil. We're not running short. We're going to have a drawdown. And this is where, again, people will overestimate. They extrapolate based on on the move down. But meanwhile, it's basically perfectly natural. It's exactly what usually happens. And it's certainly nothing to sit there and think that you're going to go higher and higher to $70, $80. Goldman Sachs has been pumping and telling people it's going to be $80 oil. That's a load of bullshit. So that'll be worth watching down the road. But like I said, this obviously we're only talking about the oil inventories of the 21st, and it is now the 26th. So this is miles behind. And it's gonna and next week we're gonna be talking about. I mean, again, if that was the 21st, if we're only looking at the 28th next week, it's not going to tell us very much information. So the opportunity here will be too short. But certainly not yet. It's just way too iffy right now. Brendan said SCO had a 4-to-1 reverse split. Anything to do? No, not really. No change in that. We still think oil is going to be under 60 at the end of the year. Josh says, can you please do a Control Plus to enlarge your screen? I guess you meant when I was on this thing. Oops, and I can't see it. Wait, that's too big. All right, I'll try to remember that. All right, so Brendan's question was the SCO had a 4-to-1 reverse split. And that just means that in one of our portfolios, and I can't remember which one, probably the short-term portfolio, we had SCO, I don't know, some SCO play. God knows what it was. Long-term portfolio is still basically where it was before. Short-term portfolio is hovering. What? Short-term portfolio is hovering in the same place at 242. Oh, SCO. Okay. Oh, I see. So it's been zeroed out. So we'll have. Okay. That's a big difference. So what happens here is we had 150 January 6 calls on SCO, and now I guess we have probably 1/4 as much of the $24 calls. So we have to that'll have to get adjusted. But that's all. Just all it did is move us into a different category. And then we sold some short calls, and we sold 75 of those. So we would then obviously be the 32 calls. And then we have a 24-32 spread. And if we look up SCO in the chart, if I find it, SCO. So we have a 24 32 spread now on SCO going into the winter, and it's a and it's 150 of these guys now. So it's a two times short ETF. So that means that we need to get from 22 to 32 to make the most money possible. That's up 10 divided by 22 is 45. That means we're going to need about a 22% drop in oil from where did we say we are now? From 66.8, 52. So we need to get down to 53 to make our money. That's what we need to be concerned about. And so we'll take another look at this thing and see if we want to maybe adjust this thing, because getting to 52 may not be realistic. We think we'll be under 60, but not necessarily all the way down to 52. You know, maybe 57, 50, something like that into January. So that means we do need to adjust, because we need to make, we need too much money to be made out of our spread. And that's what we'll have to figure out. And what do we pay for the spread? This spread cost us, oh, it was a cheap spread though. This spread cost us a couple of $1,000. So the net, you know, the net of this, not including anything else we sold otherwise, but the net of this is only a couple of $1,000. So we don't need a big win here. We just need it to be basically, it doesn't have to be all the way down to 52. We just need it to be below, I'm sorry, we need to be above 24. And we're currently at 22.15. So anything above 24, when we get to 25, that's already 150 is 15,000. That's already $15,000 at 25. We have the 24 calls at 20. Oh, I'm sorry. No. It's divided by 4. So it's going to be $3,700. So $3,700 at 25 is break even for us. And that's a very small move. That's 10%, so 5% down in oil. So we're talking $63 oil. They've actually done us a favor with the reverse split. We have better numbers. We have easier goals to achieve than before. And hopefully that'll work out. So we'll see what happens. But we're hoping for a nice big spike. We look at Yahoo, and we look at USO, not at SCO. That's the other thing is you want to see what does happen to SCO in a good spike. Well, let's say 1 year. Oh, that's terrible. Look at this. They don't account for the split on Yahoo. What idiots. Oh my God. Kind of makes the chart useless, frankly. Indicator. Nope, line, candle. Much better. Okay, so ignoring this idiocy, when the stock was at 11, you would have said the same thing, right? You would have said, well, it's going to have a hard time getting up to 20 if it's at 11. But what actually happened? It went from 11 to 50. So this thing can move very harshly. But more likely a move like this, $15 to $18 to $20, which, you know, over here, we're going from 15 to 20-ish. Here we have a move, Here we have a much better move where 14 went to 25, 26. So we're currently hoping it goes from 22 to 30, I'm sorry, from 24. We need to go from 24 to 32. 32 is what we sold. It's not an unrealistic goal. We just have to see what happens as it plays out. But right now, it's we're down here. It is very stupid though if it doesn't have the splits adjusted into the price. All right, what else have we been doing? Oh yeah, I'm going to talk about some of the trades we're making. Okay, so we had a couple of trade ideas this week. Do we have any on Monday? I don't remember. I've been doing a lot of reading and research. It's been quiet this week because not a lot of people are not really interested in the markets. because it's holidays. But I have been reading a lot of stuff trying to figure out like what we can add to our portfolios. It makes me not too uncomfortable. Viacom, still a fantastic price. That's definitely, if you don't have that, we have it in like every portfolio. Absolutely, this price is ridiculous. Nope, that's it for that one. All right, so yesterday we talked about US Steel, and we fixed this. It was originally incorrect, but it's $17 puts. You know, you want to, in this kind of economy, be into demand stocks, things that are going to be inflation resistant, and not that they don't experience inflation, just that they're able to pass it on to the consumer. In other words, if US Steel raises prices because their costs are going up, it's not like Mittal Steel isn't going to raise their prices. It's not that Schnitzer Steel isn't going to raise their prices. It's an industry-wide problem, and the prices, since they are a B2B company, business to business, not business to consumer, that the shit rolls downhill, and they're not. And generally, you can pass those costs along a lot more easily. When you're business to consumer, you may have a problem passing on prices because you're competing with a lot of other people who are trying to get those consumer dollars. If you're business to business, honestly, as long as you're in line with the other suppliers, you just pass along your cost, and the guy's got to absorb it, and he's got to figure out, your customer has to figure out how he's going to pass something along to the consumer. So I like to be on that side of the B2B rather than being the B2C guy when I can avoid it, except for, and we'll talk about that too, except for things that people can't avoid paying, like electric bills or cable bills or things like that. You know, people aren't going to get no internet. They might get a cheaper internet, but they won't get no internet. Yeah, so you know that's a fixed cost for the consumers, a lot of these things. Anyway, so US Steel, you know, simple trades, but look at the power of a simple trade like this. We are, unfortunately, make that a big chart. X. Okay. So US Steel, blah, blah, blah. You know, you can't count what happened last year much, but you know, we're at $24 for US Steel, and then I did the math, and that's only 6.5 billion in market cap, and in a good year US Steel makes $2 billion. Where is that thing? So here's US Steel. Well, they make $1 billion. Where's $2 billion? They haven't had a good year in a while. Oh, I see. This year's going to be a good year. So US Steel can make money or lose money, up and down $1 billion. It's just cyclical. That's what a cyclical does. Look at the profit. Whoop, where'd it go? Total revenue. Where'd the profit go? Oh, operating profit. Thank you. All right. So you see you can't point to the profit and be on it. So the profit goes up, it goes down, it goes up, it goes down. You want to be there when it's up and get out. You want, you know, there's see the 3 years, 16, 17, 18 going up. That's when you want to sell. When you want to buy is exactly where we are now. You see the down year in 2015, and we have the down year in 2020, even though that wasn't their fault, but besides that, but you see the down year in 2020. So they had a bad year. Now they're having a not so bad year, just like they did in 2016, and then they're going to have a couple of good years, or they might even have a good year this year. They are projecting it, that this year is going to be a good year. Revenue, perfectly fine. Money's coming in, steel is getting sold, and you can see that 2021 and 2022 are going to be fantastic years, much better than 2015 or 16. And it costs. The problem with steel is there's a lot of fixed production costs. This is why steel plants shut down all the time, because they can't, if running a steel plant costs a certain amount of money, whether you're producing steel or not, to keep it open is a very expensive proposition. So steel plants are forced to shut down sometimes because they just can't afford to keep going. you know, obviously U.S. Steel after 100 years is getting pretty good at managing their cycles, and they know what they're doing. So you just have to stick it out through the good cycles, take advantage of the, take advantage of the good cycles and stick it out through the bad cycles. We get involved now. Now they're back on an upswing, things are improving, and people are going to start saying, oh my God, the steel business is so profitable. At some point, people are going to look at $2 billion in profit and say, holy shit, are you telling me you can buy this whole company for $6 billion? You know, it's not going to stay there. They'll make $2 billion here and $600 million here and probably zero there, and then it'll start going downhill again. So, but we'll get out by then. We're just going to take it for the ride. It's going to punch up because people are always surprised, and it always surprises me how people can be surprised by cyclical companies being cyclical. It's crazy. And I wrote about that here. Anyway, they made $350 million in Q1. And so Q2 should be fine too. And they're going to make they are on track to make the $2 billion they project they're going to make this year. So we're aggressively selling the puts. We don't have a problem with owning the stock at that price at 17. And we're taking the 20-30 spread. And at some point that'll go nicely in the money. And we'll be able to cash it out early probably and take the profit off the table. We won't make all of the $20,000, but it's a ridiculous amount of money to make. And the funny thing about options is with the stock at 24.37, so the stock's at 24.37, we're able to buy the 20-30 spread for $3, $3.30. That's ridiculous. That's just not enough money. It really isn't. It's more than $3.30 in the money, and we're buying the spread for $3.30, and then we're selling some puts to lower the cost. We end up spending $3,100 on the spread, and the spread is $8,000 in the money. So why would I go and buy? And I say this every week. It's the same thing, though. You got to, I mean, say it until everybody gets the concept. Why would I go and buy? Some Bitcoin mining company, or buy some some new tech company and things like that. What am I going to buy these things in social media? It's a flash in the pan something when I can invest in U.S. Steel. Okay, are people going to buy steel? Yeah, this is how they buy steel. Every freaking year they buy steel. They buy $10 billion worth of steel every single year. It doesn't change. In a good year, they'll buy more. They can't buy less. Doesn't matter how, no, look at 2020. No matter how that finally worked. No matter how crappy the year is, they're still going to buy $10 billion worth of steel. We don't make money selling $10 billion worth of steel, but you know that's the base. And that, by the way, was a total catastrophe. Let's keep that in mind. This was a catastrophe that doesn't really happen. All right, 2015 was a different situation. That was more of an investment cycle, which cyclicals usually do. That's normal for them. What throws it off, though, is here's the money they usually put aside for the investment. Here's money they lost because they just were slow. They weren't anticipating that. That gives them less money for the next up cycle, blah, blah, blah. So that can hurt them over time. But again, I'd rather have this than sit there and gamble on a retail store and figure out, like, was this bank going to make money or not? Who the hell knows? All right, there are certain banks where you say there's a good rational banks, but some of these investment banks are scary. They can go up and down also. So that was U.S. Steel. And again, they can pass their costs along. Here's Rio Tinto with the copper being used in the building materials. Again, they're a business-to-business company. I like that. And again, such an attractive spread, 380% upside potential. So we put that in the long-term portfolio. We're only selling 5 puts. I mean, realistically, what are we doing? We have a long-term portfolio with a couple of $1 million in it. We sell 5 puts that obligates us to buy 500 shares for $70, which is what, $35,000. So our total obligation here is $35,000 plus the $6,000 we're spending in cash. So let's call it $40,000. So we have a $40,000 obligation in a portfolio where we have $100,000 to $200,000 allocation blocks. And that's all we've obligated ourselves for. If it goes badly, we have a ton of money to spend improving our position on Rio Tinto. And like US Steel, I guarantee they've got the same kind of look of a demand curve. Rio. Like US Steel, you see that? Doesn't matter what's going on in the world, you're going to have a pretty steady amount of demand. In fact, Rio Tinto is even better than US Steel. They don't lose money. Even in 2020, they don't lose money. They didn't have gangbuster earnings, but you know what? That's okay. They're going to have gangbuster earnings this year. They're going to have gangbuster earnings this year. So $15 billion a year or so, and you can buy the whole company for $135 billion. That's a 10% return. It's more than 10% return on your money. Why would you not want that? And meanwhile, you can do an option trade on that. So your worst case is owning them. And you're well, it's not even actually, you know what? It's probably better to own them that cheaply because you'll end up owning them pretty at a good price. But your worst case is owning them at 69.07. And otherwise, if you don't get to own them and it keeps going up from here, then basically you're going to get $23,000, which is a 380-cent return on your cash. There's your cash. Oops. There. Here's your cash. But this is not complicated, and it's kind of boring because basically you're just going to put it in your portfolio. We're not likely to have any discussion about it unless the whole market crashes. But we're not likely to ever talk about it again until it comes time to sell it. When we say, oh, you know what, it's already at $26,000, we can only make $4,000 more dollars, and we're done. You know, and we'll call it a day. So probably if, like, let's say next year in January or February, it's up around 95 to 100. This thing will be done. It'll be too far in the money, and we're going to give up on it. Not give up, but cash it in and take something else. What else did we look at yesterday? Oh, that's Rio again. Oh, a couple of things. Here's Intel. Intel had that great opportunity to get back in. That's their stock of the year this year. It came down nicely, but now it's heading back up. Tanker Factory Outlet. They're doing a buyback. They still think it's way undervalued. They've gone up, obviously way up. We were screaming for people to buy these guys when they were down around 6. Now they're at 17, and the company's like, screw you, this is worth more than 17. And so they just expired. They just ran out of money on their first round of stock, and they're like, we don't care that it's 17 now. So they bought a whole bunch of their own stock back here. And now they're buying another round of stock, even at the higher price. So is that, is that better or worse than the dividend? I don't know, but it's frankly, who cares? Because the money is just pouring into this company now. Alaska Air is another one. It's one of my favorite airlines. They're not cheap. We haven't been playing them lately because they got too expensive. But as you can see, $70. They're probably consolidating for a move up as well. This is we should have a much better year for air travel now. And you can imagine people in Alaska definitely want to get the hell out of that place and go somewhere. Can you imagine like not being able to leave at all? It's so annoying. Because they can't even drive anywhere. It's not like there's anywhere to go from Alaska. If you can't fly out, you're not going anywhere. Except for the ice road truckers, right? What else? Oh, next day. Okay. Home. And that brings us to today. And today we looked at Imax, and Imax is, again, how obvious, because Imax Now, this is not, IMAX is not a business to consumer. This is where people get very confused about IMAX. IMAX sells the screens and the projectors to the movie theaters and the sound system to the movie theater. They do not make movies. They do not, they do rent out the equipment to the producers to film an IMAX, but they don't make movies. They don't take a risk on the productions. All they do is have ticket sales that they get a piece of, and usually in their arrangements they have with the theaters. So they have a risk that the films that are filmed in IMAX don't do well. But if you think of the economics of it, people who are making IMAX movies, which are generally the blockbuster movies, they are already watching those investments very carefully, and they have a very definite return on investment. And while some movies may disappoint, and some may do well, and some will disappoint, but on the average, you're going to get X amount of eyeballs coming in. Otherwise, they wouldn't be doing them in the first place. And the studios love the IMAX format. There's no big budget movies that aren't done in IMAX, basically. So I'm not, well, I mean, no big budget. I was gonna say no big budget movies that aren't action movies, but pretty much all big budget movies are action movies. Anyway, so things get shot in IMAX. That's bottom line. So IMAX revenue, whoops. And look what happened to them in 2020. Holy crap, right? Because everything shut down. Their revenue stream shut off and they got screwed. But more theaters were still being built. Installations were still being done. And they still have more net theater ads than they had before. They're just waiting for the box office to come back. And so this year's already shot because half the year's gone and we're only just getting the movie theaters reopening. But as I noted earlier, the box office numbers are coming back. IMAX is able, they're gonna just steadily improve every year. And their profit should go, if this hadn't happened, they would be doing 80, 90, and then 100, and then 120. They're going to be way whack behind. That's operating profit. They're going to be way behind. Instead of going 20, 40, 60, that's what should have happened. They got interrupted. It's still 20, 40, 60, 80, 100. So in a couple of years, they'll be doing $100 million. You can buy the whole company for $1.28 billion. It's a growth company. It's not a stagnant. U.S. Steel is a stagnant company. Okay, Rio Tinto is a pretty stagnant company. This is a growth company you're buying for 10 times earnings. That's crazy. 10 times forward earnings. So that's going to keep going. And IMAX just can't. They're backlogged in orders like Boeing. Okay, they just cannot possibly get caught up on the amount of orders there are for screens. In China, in India, around the rest of the world, in Europe, there's people are ordering IMAX screens everywhere. There's no viable challenger, and the reason there's no viable challenger is, again, the movies have to be shot in IMAX. So unless somebody invents a format that doesn't require special equipment, which is, highly doubtful, but unless somebody comes up with a format that doesn't require special equipment to shoot the movies, the studios already have an incredible fortune invested in IMAX equipment and IMAX editing systems and everything else. They've already spent all this money. It's already sitting there. People for years have been trained on IMAX equipment. The best cinematographers in Hollywood, the photographers, all the people who work on the productions are all trained in IMAX. If a competitor came along with a different format, then you would have to basically buy all the equipment, buy all the editing equipment, and start shooting the film in a different format. But meanwhile, where are the theaters to shoot this format? There's some kind of Dolby Digital thing that AMC, I think it's AMC or Cinemark, one of the two. One of the theaters has a Dolby Digital something that they use, and that's supposedly the sound is good. I'll tell you that, I've been to them. The sound is good, but the screen is not, obviously nothing like it. It's just a regular screen with maybe a brighter picture or something like that. But I don't think that's a serious competitor. I really don't. And it's not prevalent, because if you don't know what I'm talking about, then it's certainly not prevalent. IMAX, you know where IMAX is. Everybody knows where IMAX is. So how are you going to replace that? How are they going to get circumvented when they've got such a strong marketing position now? They are worth shooting. It's already happening. Films are shot in IMAX. So they're gonna have a very long run, and they're only at the early stages, frankly. And more theaters with IMAX means more and more films will be released in IMAX, means more and more revenues for IMAX. It's not a complicated proposition. So over the years, whenever IMAX does take a dip, we tend to buy it, because it's just a good, solid company. It obviously has its own cycles, especially when they're on an investment cycle for like building and building new screens and things. They have to put money up front, but it's definitely a $20+ company. So when we can buy it for under 20, it's good to buy. By the way, I cannot believe I was asleep at the wheel when this happened, because we should have jumped all over this. Obviously, I think we did buy it and we got out already, but I don't remember. Who knows? There's so many opportunities when people are panicking. But since it's generally a steady $20-ish company in the low 20s, and we're not expecting, nothing magical is going to happen, they're just going to get back to normal. So we decided to put it into the butterfly portfolio, where we're going to sell, take advantage of the range-bound nature of the company, sell puts and calls, and bring an income in. So instead of taking 1,000 and only making $13,000 against the cash outlay of the spread, what we're doing is we're taking the spread and we're selling puts and calls. And if we sell these puts and calls every quarter for, right here, 1,700, the July 22 calls are out of the money, so they're 100% premium. The July 21 puts are out of the money, they're 100% premium. Obviously, we could easily go in the money on either one, but we just roll them out of the way and push them along. And all that means is one of these months, one of these might not pay off, and we roll it, and then we miss the opportunity for half of the, for one of these things not to pay off. Then the next month, one day, sometimes both of them get hit and we make all the money. Sometimes only one of them gets hit and we have to roll the other one. But if it stays more or less in its range, which is anywhere from like $16 to $25, if it stays in that range, eventually we're going to make all of our money, and it can add, the potential is $17,000. But realistically, figure, you always look at the potential and figure if you should make about half to a third of that. And when you get lucky, you make the money. When you don't get lucky, you roll it along. So it's a miss. But even if you make half of that, it's incredibly substantial when you're only investing $1,000 of cash and you bring in an extra $8,000 in revenue. Plus, if it does what we think it'll do, which is drift higher, and we're only looking for 27. But if it does drift along and go higher and ends up at 27, we're going to have another $13,000. You could be up $20,000 on $1,000 on this trade. It's a great way to play something, and that's fun, at least, because every month or so, every few months, you get to make a decision. You get to trade your stock, blah blah blah. So if you're the kind of person that hates to just sit around and watch stocks, this is a great way to do it. It also throws off a little bit of an income, which is very nice. Then we got Ford. Ford just had their electric vehicle day. Well, I wonder what they announced today. So Ford's having their vehicle day today. They're announcing a bunch of electrics. So the price shot up 7%. Since I mentioned it this morning, it was at 13 this morning. I was like, wow, that went up quick. Same kind. You buy the calls, you sell the other calls, you sell some puts. $2,600 on a $1,500 spread has 476% upside potential for Ford. It's freaking Ford. They've been around for 100+ years. They're not going anywhere. Even if they drop 50%, they're still not going anywhere. Especially with Democrats in charge. Joe Biden's president for 3 more years. Okay, he's not going to let Ford die on his watch. So therefore, if Ford takes a tremendous hit and goes back to 7, we will just load up the truck with more Ford. So these are not risky investments, but these not risky investments are paying 400% and 1,000% or whatever the hell it was over here, and they're paying. Oh, and I forgot about that one. Oh, let me talk about selling some puts also. And the Imax pays 1,300%. You know, this is how you can make money in this kind of market. We're not taking risks. We're not buying crazy stocks. We're not buying anything we're going to regret passing on to our children. This is how you play it. In the long-term portfolio, we just sold the puts because we get $10,000 for just selling the puts. We promised to buy 5,000 shares of Ford for $12, $60,000. So we promised to buy 5,000 shares of Ford for $12, but it's 60,000 minus 10,000 is $50,000. So we're spending $10 a share, a little bit lower, $9.85. So we're offering to buy Ford for $9.85 a share. It's freaking $13 right now. We're offering $9.85. We're saying if it comes back to $9.85, we'll take 5,000 shares in our long-term portfolio. And again, that's a quarter of an allocation for us in the long-term portfolio. Not a big deal. What are we really doing? We're really collecting $10,000 against the cash, or the would-be cash of $50,000 that we're committing to the trade. So we're committing. We're getting 20% over 18 months on our money that's sitting in cash and not doing anything. From a margin perspective, we're using $5,000, $6,000 in margin. So it's a very margin efficient way to get some money too. But the bottom line is, even if you're in cash and you're not doing anything with your cash, 10% a year on cash is better than a T-bill. It's better than a junk bond. It's better than anything you can invest in, and all you're doing is promising to buy Ford if it gets a lot cheaper. This is how you make money in a portfolio. This is how you invest. Not gambling, we're investing here. We looked at NRG. I think NRG is bottoming out here. This is a good spot to get back in. It came down sharply. What happened to NRG is that thing in Texas that happened with the electrical thing and whatever, and everybody got in trouble, and the rates were crazy. So the bottom line is they lost $750 million in that during all that crap. And at the same time, they also acquired somebody, which is terrible, terrible timing, because they acquired somebody who was in the same boat as they were. They acquired another Texas carrier. That's not good. So that all sucked, and it basically it hit them for like $750 million. In a typical year, these guys make $1 billion. But so if they make $1 billion in a typical year, and they lose $1 billion, which they didn't lose $1 billion, $750 million, then what do? You amortize it out over 5 years, and you say, okay, well, $1 billion divided by 5 is $200 million. They make $1 billion. So for the next 5 years, they're taking a 20% hit. Therefore, if the stock drops 20%, which would be $8, $9 off of 44, which is 35 basically. So if the stock drops to 35, you have now hit the point at which this is taken into account. And we're not accounting for future growth or anything else. We're just saying, okay, assuming they get back to normal and they keep making $1 billion a year and forget growth, forget everything else, then this will wash out in 5 years, and you're going to be back to then after 5 years, though, now you're sitting on a company that's free and clear, making enough to justify 44 again. So meanwhile, what are we doing? We're saying, you know what? We've got the $30 calls, but we now think that might be light, because the $30 calls, we think that this is probably the right price now, about $35. So that's no good to have the $30 calls. So we take the calls, we roll them down to the $25 calls, and we're actually doubling down and rolling down because we're taking advantage of the low price. And so now we're taking 20 of the $25 calls at 25. We're going to sell the $35 calls, but only when they get a little bit more expensive. Right now they're $4, and we want to sell them for $5. So when the $35 calls get to $5, we sell those, and that means we only spent net $4.25 on the 25s. So we have plenty of room to go. We have a very realistic target at 35, and we'll have a nice double out of the thing when it's done. And then of course we got the short puts too. And that's it. Pricing the NRG roll is way out of whack. You've priced at 195 to roll when it's closer to 4 and has been. Would you still roll at 4 or 450, Jeff says? Now, Let me see. No, I would not. I would not spend more money. What I would do is I would buy. Look, what's our plan? Our plan is to roll down to twice as many of these. So what you want to do is offer to buy. I would offer to buy 20 of the 25 calls for $9.25. That's step number one. I would buy those first, and I would wait on selling the 35 calls. Yeah, you don't have to sell these now. You can wait because our premise is it's going to go higher. So I mean, basically, I would buy these first, the longs. I'd buy the longs. You can start by buying 10 and wait until you sell these 10 for the target price. But start by buying 10 of the $25 calls. At least I would buy. I mean, we have so much money in the LTP, it doesn't matter. But I would buy. I'd buy the calls first because we think it's a bottom. What's our premise? Our premise is this line is going to hold, and then it's going to start going back up. So our premise is that we're bottoming here. So we start off by buying the calls. We wait until we get, and I already said that anyway, we're waiting to sell the 35 calls. And obviously, if we're waiting to sell the short calls, we can wait to sell the long calls too until we get our price there. You don't have to get the price all at once. You can make it work. You can figure it, you can make it fit in. Don't just take whatever prices are being offered. And a lot of these brokers are awful with their spreads. So they're not going to show you what a good price is. You have to pay attention to what the bid and ask is and what's actually being sold on the charts. You've got to look at the charts. You've got to figure out how much money you can actually get for these things. And when I put in these numbers, I put in what I consider reasonable, not what the bid ask is. I put in what I believe can be gotten for the thing, and that's the offer I will make. And if I have to wait 3 or 4 days, I'll wait 3 or 4 days to fill it. I don't need to fill things right away. That's really important. You've got to learn to do that. And we can talk about that. It's something you can work on in chat because that's a real important skill, is to learn how to fill these things. But it starts off, in this case, what's your premise? In other words, why am I doing this trade? I'm doing this trade because I think NRG is bottoming. Therefore, my entire premise is it's going up from here. So my action should reflect that. My action should be like, okay, in that case, I want to sell puts while I can. Well, we already sold the puts, so that's out. But if you haven't done it, I want to sell the puts while the puts are a good price. That's number one. Number two, I want to buy calls while they're cheap. And I want to sell calls when they get more expensive later, when it bounces. So, you have to understand, what do I think the stock is going to do? What is my premise for being in this thing? And if you do it like that, you can vastly improve your spreads, because you need to do that. You need to get good prices. Don't just accept any old price and jump into a spread. And that includes the roll. Same thing. It's the same concept. If I'm rolling, what is my goal? What we're doing here is we're rolling 10. We have 10 long calls, which means we have to sell them. And I'm damn sure not going to sell them for less than 750 or 730. They say 730. In fact, I'm going to ask for 750, especially if it's going up today. Not much up, but it's going up a little bit. So I want to ask for 750 here. I want to offer, if it's going up, I'm worried. So I'd probably offer 925, 935, 950. I want to get at least 10 for 950 or less to get started. So I lock in at least something. If I can't, see, here's the thing. If I can't get these for less than 950, then I should certainly be able to sell these for 750. One or the other has to happen. Either I'm going to get the cheap 25s or I'm going to sell the expensive 30s. One of those two has to happen. If the stock goes down, I'm going to get my cheap 25. If the stock goes up, I'm going to sell my expensive 30s. They can't both not happen. One of them is going to kick in. So you can, you basically, what you do is you always want to offer a good amount for each side and get yourself filled. And then once you do that, and you can do a few at a time, but once you get a good price, then you say, okay, what's my next good prices I can get? And you work your way into these spreads. I hope you guys, SK had problems hearing me. I hope the rest of you guys can hear me okay. Oh, it's funny. I'm answering him, but he's not necessarily on the webinar. I just realized that. All right. Well, I hope you're there, Jeff. We will discuss it after. I'll put an answer in the chat. I just realized that he's like, that wasn't a webinar question. That was a question in the chat room. All right. Like I said, I don't have a lot of time today. Got a lot of stuff going on. Fed remarks, aid treasury. So we had a good 5-year auction. And that was probably we'll see that in the chart though. There was a lot of bidding on the 5 years. Oh no, that didn't come out that well. I thought it was a good 5-year auction. What time is that? Oh, it's not going to tell you what time. Is it? Yeah, wait. Yep, 1 p.m. Here's 1 o'clock. Oh, well, for whatever reason, it wasn't interpreted as a good auction, but I thought there was a decent amount of demand for it. But we had a 5-year auction today. But the notes are all weakening. So I guess it didn't go as well as you would think. I don't know if we have a 7-year tomorrow. I'm not sure if they're following up with another one. Calendar. Do we have the calendar? That's not a calendar. That's not a calendar. None of these are calendars. Oh, Monday. I remember last week we were talking about short in oil. Sorry, going long on oil, and those paid off really well to start the week. That was a good trade. XRT is still hanging in there. Earnings. We'll talk about some earnings with. Oh no, where's the calendar? Oh, there it is. Okay, tomorrow GDP. That's important. Durable goods. That's important. Corporate profits is part of the GDP report. Pending home sales. Homes have been pretty weird. They've been all over the place. The Kansas City Fed and 7-year note auction. Yep, 7-year note auction tomorrow. So that'll be another indication for the bond market. This is not good. See the economic surprise index? So it's actually neutral, but what it's saying is basically that the economic reports we're getting are neither better or worse than expected. That's what that means. When the economic surprise index is high, it means that most of the reports are coming in better than expected. When the economic report index is low, it means things are coming in worse than expected. Okay, so that's how you can tell what's going on in the economy. It's a good indication of whether or not people are on the right side of the trades or not. The thing is, when it gets to zero, and reports coming in as expected, it means all the euphoria that was driving us for the first part of, earlier last year when people were expecting doom and gloom, things got better. Everybody had poor expectations, and then expectations have now moved in line with what's actually happening. It doesn't mean the economy is getting worse or better. It just means that everybody now is seeing the market for what it is and seeing the economy for what it is. So it's a surprise because something changes that people aren't aware of. So we're on the money here, but that means that where's the driver for the market? So until we start seeing better numbers and still things are better than expected, like they were here, you don't have a very good driver. I ran out of liquid. You don't have a very good driver for any more gains in the market. So this is big tomorrow. It's going to be the GDP report. We'll see how that goes in the morning. And we talked about XRT, and we're going to talk about who's going to have earnings. NVIDIA, are they going to be affected by the chip shortage? We want to know. American Eagle don't care that much. Williams-Sonoma, we always like those guys. Best Buy. Now, Best Buy, I didn't consider them cheap. I like them a lot, but they're not a really good price. Unfortunately, BBY. you know, they've already had their gains, so they're no longer particularly attractive. I mean, when they were $50 in March, they're $120 now. It's just a little, and I don't have to look, but I mean, I'm just telling you that BBY. $28 billion, and if they make $2 billion, that'll be a lot. And it's not terrible. It's fine for retail. It's a good spot. It's not compelling though. So that's what it is with these guys. They're not in a compelling place. There'd be nothing at all wrong with owning Best Buy down here though. It's certainly a good company, good retail outfit, long term, but just not worth bothering basically. Dollar General should be doing good. Dollar Tree should be doing good. Burlington, I don't think so because you got to go there. You know, go there, try and cook. I just don't think people are doing that yet. TD, we've got bets on. We like TD. What is that? RBC? Oh, that's the RBC Bank. Costco always does well. Salesforce usually does well. Gap is doing okay. HP, Ulta is does well too. Dell, should be okay, I guess. Big Lots doing very well. So nothing that's likely to derail anything in the next couple of days. And of course, the volume of work is going down and down. When I talk about the SPY volume, okay. So let's see if we can go back to. When I talk about the SPY volume, I just look over here on Yahoo, and you go to the historical data, and you just look at what the volume levels were and are. So, you know, you're in like the 80s, 100, whatever. May 18th was a slow day. But then all of a sudden this week, 50, 57, 22 at the moment. Probably still end up at 50. May as well be closed. I mean, that's some really, really low numbers. And we had a streak back here in April where we had some really low numbers too. I think that was like Easter or something like that though. You know, last year was weird. I mean, last year in February, we had these crazy low numbers in early February. You know, so we go through bouts of this, and any excuse for people not to bother trading or to walk away, it happens, and that's what's happening right now. And you cannot, you know, make any sort of inferences for what's not real in a market that's this thinly traded. I mean, this is like no volume, basically. It's all, you know, we already have a pathetically low volume market, but now we're like half of the pathetically low volume. So you have to take everything that's happening here with a grain of salt, because it's really impossible to draw any conclusions from the action that's happening there with that kind of volume. Just looking to see if anything exciting is going on in the news. Nope. You know, in Bloomberg Digital that I get on my smart TV thing, I don't know, you get a digital version of Bloomberg and it's got like a lot of stuff on the right side of the screen. They have a TV schedule. They tell you who the guests are that are coming up. And it's interesting because you can actually, based on that, if you look ahead like a half hour, 45 minutes, you look at the people who are coming on, especially when they're like a CEO of a company. And if you look up the company and you look at what they're saying very recently, and you can imagine the CEO is going to talk about whatever, if it was positive, the CEO is going to talk about whatever was talked about recently, you can pretty much anticipate an intraday pop based on somebody coming on Bloomberg and saying something, because they could talk about it and say something at the meeting or say something at a recent event or something to be in the news yesterday. But an article doesn't have the same impact as a TV appearance. When someone gets on TV and actually says, quotably, we expect a gangbuster quarter, blah, 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 that's a big thing, and that'll move the market. You know, and Bloomberg, unfortunately, doesn't have the sort of the stampede effect that CNBC does, but you still get the movement, and also CNBC then picks up on something if Bloomberg has it. That works too. It'd be nice to get CNBC scheduled that way, but I don't think you can get that. But it's an interesting way to play, because I never used to. I used to watch the regular Bloomberg. Now I watch this digital version of Bloomberg. And it's weird because I don't understand why people don't take more advantage of this. They're telling you who their guests are for the next hour. And so all you have to do is look ahead and do some reading. And I mean, I guess it helps if you understand like what each company does. They're in commercial now, so I'm waiting for it to come back. But if you look ahead and you do some quick research, you can get yourself a pretty good short-term and intraday premise to play something. It's kind of fun. Adobe signing. Adobe's really pushing that signing thing they've got. Walmart is telling you they're going to replace 50 million acres of forest. Guess that's good. I don't know. Boy, they have a lot of commercials. Willie Nelson is working for FedEx. He's got to be so old now. Everybody's got like Earth Day sort of advertisements. Come on, Jesus Christ, that's a lot of ads. No wonder I don't watch this. No wonder I watch digital Bloomberg. That's crazy. All right, hopefully it's the last one. I don't even know what I'm watching here. C3AI. Oh, Enterprise AI. Because I got the sound off. I had no idea what I'm looking at. Oh, great. Now it's not. I got that little circle thing going on the screen. Now it's not reloading. Maybe that's why I played all those ads. It was trying to figure out if it could load something. Anyhow. Nope, it's dead. There's a lot of waiting for nothing. Anyway, so conceptually, let's see. Maybe it's on here. Bloomberg.com. Or we want to find the TV part of it. US edition, Europe, Asia, Africa, Bloomberg customer, Bloomberg login, Bloomberg terminal, menu, Bloomberg TV Plus, US. Maybe it does the same thing. Maybe this will show it. Hang on. Yeah, it looks the same. That looks like my TV does. Whoop. You're in theater mode. Come on, come on, come on. Show me this. Show me the money. Is it plausible? It doesn't look plausible. Top news next. Interesting. Is that what's going to happen? Aha, that's what I mean. All right, so it's actually showing less people than the other one. So JP Morgan Asset, Option Pit LLC, now it doesn't sound interesting. Your own strategist, Neuberger Berman, oh no, so there's nothing interesting here. Damn it. All right, anyway, although if you look up David Leibowitz and you find out what he's talking about today, you may be able to figure out what he's actually talking about. So either this guy or Carol Schlief, one of these two people may have already said something that you can look for, but you get the idea. So another point is, when you see that, and that I swear the list is longer on the television, and the indexes are weakening here. See what's going on? When you see that, you could then just start doing a little bit of research real quickly and see if there's an interesting premise in who's coming up on TV, because they're going to come on and say something. So Icon's on the phone saying whatever, but we knew Icon was going to be on the phone. And had it been something where we knew what he was going to say, but when you see the CEO of Coke or Pepsi or you know, or the Exxon guy, so let's take David Leibowitz for example. So David Leibowitz. Do I mean David Leibowitz? Oh, I do. JP Morgan. So it's David Leibowitz. Original recipes. Yeah, this is hard work. All right, news. There you go. So TSX strength. So BNN Bloomberg. So that's he's already been on Bloomberg Canada 4 days ago talking about TSX strength. So he expects the market to be strong into the end of the year. That's not helpful. We would rather have him talking about cyclical value trades have room to run. What you want to do is find an analyst who's recently said something positive about a company, and that would be your tip-off, that you would know that he's going to come in here and talk about that. So that's my concept anyway. So it's just an idea I had from watching this where I was like, holy shit, you know, they tell you who's coming on. And obviously you've got to be patient, but once in a while, they're going to tell you, let's say Carol, SCHLEIF. Carol, SCHLEIF. Carol Schlief. And what does she have to say for herself? Bloomberg, the close, digital, full show, 5-5. Carol Schlief, Deputy CIA, Abbott Downing, Stocks and Bonds, Finance and Commerce. Oh wow, look how she's very rarely on. So let's say all. She's rarely on television, this woman. Nope. So the point is, you can't definitely see, wow, she's never on TV. All right, so again, no opportunity there in particular, nothing exciting standing out. But the point is, when you find something, there's a tradable idea. There's something, if you like to day trade, that's the coolest piece of information you could have. This guy's going on Bloomberg, and I know what he's going to say. I know he's been going around talking about this or that. You're going to strike out a lot as far as like doing the research, but when you find one, it can be very interesting. So maybe next week, you guys remind me, we'll see if we can find something good. But like I said, the best one is obviously when you see a CEO coming on and you know this, it's either you're looking for an analyst who's just recently upgraded somebody, that's going to be good because you want them to talk up the company, or you want to find a company that has recently made some sort of a good comment or something like that, and you know the CEO is going to come on there and give it a good spin. Then all you're doing is looking at that knee-jerk reaction where people buy it and it pops up a little bit, and you get in and get out and make a little bit of money. It's fun. My plan, and we'll see how it goes. But next week we can take another look at it. All right, I have to wrap this up. I'm sorry, I have a meeting in a little bit, and I got to go to that. It's going to be the rest of my afternoon shot. So let me see if anybody has any last questions. SK is back and he can hear. Fantastic. All right. It was a reboot issue. I'm glad to hear that. And it's not like the seminar crashed or anything like that. So that's it. We're going to have a weekend, and it's going to be very slow. That's the bottom line. And coming back from the long weekend is probably should be slow too. So there's not much exciting going on. We'll see how the GDP comes out tomorrow. We'll talk about that in the morning. And other than that, just have a lovely week, and we'll do this again next week. All right, take care, everybody. Oh, on the 7th, which is I'll talk about that in the next webinar. So next week, the news guy's coming. Bill Owen is coming from Newsmax, and we love that program. So we'll talk to him about that. And again, it's opportunities in the news. This is what, you know, if you want to get into the short-term trading, that's what it's all about. You got to keep your eyes open. On the 7th, 5th, 6th, 7th, on Monday, June 7th, I'm doing a half-hour sort of a training thing. I'll give you links when we're coming up to that. It's just a basic option strategies on how to make money selling options. Everybody here should know that. but it's fun sometimes to hear me do it, and I'm going to be interviewed and so on and so forth. All right, thanks everybody. Take care and have a good week.